high one move before June 30th can cut a high earner's tax bill by around $9,600 in a single stroke, according to ATO cap and rate figures. That number sounds too big until you see how it works. You shift income taxed at 47% down to just 15% inside super. I ranked all 8 legal ways to reduce your taxable income by dollar impact, and the countdown ends with the biggest saver of them all. I read the fine print so you don't have to. I ranked these 8 moves on the actual tax saved in one financial year, how easily you can act before June 30th, and whether it's fully within ATO rules. Every figure here comes from ATO concessional caps and the 2025-26 marginal rate tables, nothing invented. Let's count down from number 5. At number 5, prepaying deductible professional fees. Pay your registered tax agent and a professional subscription before June 30th. Say $200 in total, and per ATO prepaid expense rules you claim it this year. On a 34.5% effective marginal rate, that's about $414 of tax save for a payment you were making anyway. It's small, but the next one moves into thousands. Number 4 is tax loss harvesting. Capital losses realized before June 30th that can offset your capital gains that same year under ATO CGT rules. In our example, selling shares to bank $8,000 of losses against a $15,000 gain cut the taxable gain and saved $1,560 in tax. And remember, after the 50% CGT discount, only half of a gain on assets held over 12 months is taxed anyway. Number 3. Partially topping up your concessional super. Here's the sting. A top rate earner who only uses half of the $30,000 cap leaves $4,800 in unnecessary tax on the table that year, because that's 32 percentage points of tax on $15,000 per ATO rates. If this is useful, subscribe where the next breakdown is already coming. Even a partial top-up matters, but the full version sits much higher. Before I get to number 1, which is the most counterintuitive part of this, number 2 is prepaying investment loan interest. Australians can legally prepay up to 12 months of interest on an investment or margin loan before June 30 and claim it now under ATO rules. On a $400,000 loan at 6%, that's a $24,000 deduction, worth roughly $9,360 in tax at a 39% marginal rate. It nearly tops the list, but number 1 edges it, and here's why. So what beats a $10,000 interest prepayment? The number 1 move wins because it isn't a timing trick that you eventually pay back later. It's a permanent rate swap. You take income taxed at up to 47% and move it into an environment taxed at just 15%, a full 32 percentage point gap per ATO figures. Here it is. Number 1. Maximizing your concessional super contributions up to the $30,000 cap for 20 and 25, and here's 26. For someone earning over $190,000, directing that full $30,000 into super instead of salary swaps, 47% tax for 15% tax, saving around $9,600 in a single year based on ATO caps and marginal rates. It's the biggest dollar impact on the list because the saving is permanent, and if your super balance was under $500,000, you may even carry forward unused cap from prior years for a bigger deductible contribution. Number 1 isn't for everyone. If you're on a lower marginal rate, the 32 percentage point gap shrinks and super locks your money away until preservation age. If you need liquidity or you're property heavy, prepaying investment interest at number 2 might genuinely serve you better this year. Match the move to your income and your cash flow, not just the top of the ranking. Next, I'm breaking down the carry-forward super rules, how people with balances under $500,000 can legally contribute far more than $30,000 in 1 year and slash a big tax bill. If you want to catch that one, subscribe so you don't miss it. As always, this is general information only, not financial advice.